Welcome back. Today we're talking about another firearm company. If you watch the channel at all, you'll know that I like Smith & Wesson. I'm an owner of Smith & Wesson. So what I wanted to do was look at another firearm stock to compare it to, not just to compare it to Smith & Wesson, but see if it's also a good play on its own. I mean, look at this. The PE is less than 10. It's near a 1-year low, and it yields close to a 5% dividend. So that's worth looking at all on its own, okay? And then let me show you one other thing about this stock that's interesting. And that's that it's also a magic formula stock. So if you don't know what the magic formula is, I went over it in detail in my AtCore video, and you can see AtCore right here is a magic formula stock right there, AtCore. So basically what Joel Greenblatt does in this website is he ranks what he thinks are the most undervalued stocks in the stock market. And he doesn't do them in any particular order, but he gives you like the top 30. And this is the top 30 if you filter above $1 billion. So you see up here, I filtered for over 1,000 million, okay? So over $1 billion. So these are the top value stocks, in his opinion, over $1 billion based on the magic formula. And there's RGR right there, Ruger, okay? So as if it being in the same industry as Smith & Wesson wasn't enough, this like really made me want to look into it, all right? And the reason, just so y'all know, that Smith & Wesson is not on here is that it's under $1 billion. It would show up as a magic formula stock if I remove the $1 billion requirement, okay? All right, so let's get started. The first thing I want to go over is the NICS firearm checks, okay? So if you don't know what this is, basically in the United States, every time somebody buys a gun, there is a background check that's performed on them. Then this number of background checks is published by the FBI every month. And so what I did, and they put it on their website, and it's in a terrible chart that you can't read. So what I did was manually entered all that into Excel to get this graph. And you know, one thing about the channel that I always emphasize is the power of graphs, right? I think that it's a much better way to look at data. I think it's easier to see patterns like this than just looking at a table of numbers. I mean, who can do that, right? All right, so what you can see here is that we did have this huge spike up in firearm checks, or firearm sales, really, around the pandemic, all the civil unrest with all the protests and all that, and we've come down to earth a little bit. But the general trajectory is still up, okay? So these companies are still growing sales. There's continually more guns being bought, that sort of thing, than there was 5-10 years ago, all right? And to demonstrate that, I want to do a growth rate. So what I'm going to say is that like 10 years ago, or let's say 13 years ago, 2009, there was about 1 million checks a month, okay? Like, let's say hovering around 1 million checks a month. Right now, we're about 2.5 million, okay? So you can see right here about 2.5 million. So from 2009 to 2022 was 13 years. So what I'm going to do is 2.5 divided by 1, all right? And then I raise that to 1 over 13 to get an annualized growth rate. And you can see that the firearm market's been growing at about 7% a year since 2009. I think it'll continue to do that. I mean, that's what the trend says, right? So I think that's a pretty safe growth rate to assume whenever you're valuing these companies, right? Maybe a little bit off from that, but it's going to be close to 7% a year if you think that their market share is going to remain intact, all right? Okay, so that's enough about the industry. Let's move on to Ruger's financial statements. First up, like we always look at, is revenue. And really what I like to look at here, and this is every quarter going back to 2007, 2008-ish era, okay? So what I like to do with revenue is make sure it's not shrinking. And, really I'd like to see revenue growth, but I'm okay as long as it's not going down, right? And I mean, it's pretty stable. I mean, they had this huge spike during the COVID period, but I mean, for the last, since 2012 to now, has been pretty flat. So that's a little worrying because, in my opinion, if the firearms market's growing like that, it's 7%, and your revenue's kind of flat over that same period, that's a little bit concerning, okay? But anyway, that's just the revenue. We got to look at how much money they're making, what's their margins, what's their income, that sort of thing, okay? So what I'm going to do is look at gross margin, and this is a trailing 12 months. So what gross margin does is it gives us a great idea of the competitive advantage, because gross margin is how much you're able to mark up your products minus what you paid to make them. What did you pay for the pieces and parts versus what are you selling them for? So a company that's having to cut gross margin to maintain its competitive advantage is not good, because it means that it's in a price war. And one that's growing gross margin is great, because it means that it's able to continually charge more for products and not lose market share, okay? You can see their gross margin is pretty flat. I mean, hovering between 30 and 35%, maybe 25 to, 1 second there. This is a little bit concerning because you can see their gross margin really decreased in this time period. And then they had this spike from COVID. I say COVID, but it was really from all the riots and stuff that was going on. So what I'd really be worried about is if gross margin's trending back down in this direction, which would really, really, really hurt earnings, okay? So that's something I'd be worried about. Next, I just want to jump to pre-tax income. Okay, so pre-tax income, I love pre-tax income. I think it's a great way to compare a company to its history because tax rates can change. It's a good way to compare apples to apples. Okay, and what I'm looking for here is same thing as always, right? I want to see growth and consistency, and this one is not really consistent or growing. Okay, so you can see, before that 2020 time frame, pre-tax income was really shrinking, all right, and now it's back down, so that would worry me a little bit. All right, and then lastly, I'm going to get earnings per share. Oh wait, first I got to get a number here. What do I want to say? Let's say that I think they're going to drop to 20 million a quarter. So let me put that here: 20 million per quarter. All right. And then lastly, diluted earnings per share. And then what I've done is I've done trailing 12 months of diluted earnings per share. So what you got to look for here is that this is not a quarterly number. This is the last 4 quarters of earnings every quarter. So this is a little bit better. We're on a general upward trajectory from the beginning, but it's still coming down like it was. So the question is, what do we expect it to kind of settle down at? It's, let's say probably, I don't know, $5 a share or so per year. So let's just say $5 a share. All right, so that's really it for the income statement. I want to look at the balance sheet next. One thing I really liked about Smith & Wesson, let me move to total assets. One thing I really liked about Smith & Wesson is that its balance sheet was super strong. It had a great return on assets. It was growing equity. It had repurchased shares, that sort of thing, okay? So that's what I want to look for in Ruger, right? I want to see return on assets, number of shares, growing equity. All right, so here's total assets, and I always look at total assets because what I'm really interested in is return on assets. I want to know how much money a company's making versus their total assets that they own, okay? And so what I do is I pull up return on assets, and I put this in percentage, and you can see we're at about 10% return on assets. And that's, it's crossing under that, so now we're under 10% return on assets. That's not that impressive to me. It's okay. I'm kind of confused how it wound up on the magic formula with low return on assets like this. Usually whenever you see stocks on the magic formula, their return on assets is like above 20% or something crazy like that, but whatever. All right, next I'm going to look at inventory because this is super critical for companies that sell goods, right? Because if you have growing inventory, that could be a sign that demand's really cooling, and so you're building up inventory on the store floor and stuff, and that looks like it's what's going on here. Look at this. Inventory's just been building every single quarter. Now, it's not higher than it was in this period yet. It actually is higher, but it's not significantly higher. I think it's just recovering from this time in 2020 where, people just empty the shelves as far as guns go. But at the same time, I don't like to see growing inventory this fast. And really, though, with inventory, what you're more interested in is growing finished product. Because growing raw materials can be a good sign. Growing raw materials can mean the company's, bracing for more demand and they want to build up raw materials so they can make more. Growing finished goods is like, hey, this stuff's not selling, right? All right, so this is kind of concerning. Obviously, like I said, it's recovering from being completely emptied during COVID. Look at this. Their inventory, look how low it was. It was close to zero. So, it might get a pass there, but at the same time, it's still a little shaky, okay? All right, and then lastly, I'm going to look at equity per share, but not just equity per share, tangible equity per share. So the way I calculated this is I just took the equity per share, subtracted out goodwill and intangible assets, and I want to see this growing, and it is growing, okay? So this is good. And let me just get a growth rate here. So let's see, what is this time frame? This is like 2009. So 2009, they were at $5 a share, and now let's say they're at 20. So they went up 4 times in 13 years. So 4 raised to the 113 is 11% growth annualized. So this is pretty good because even though the earnings are a little bit shaky and they're paying a dividend, right? I talked about that in the beginning. They're still able to grow the net worth of the company, and that's usually the case with companies with really low debt. And if you looked at their balance sheet, you would see they have like almost no debt. It's kind of same as Smith & Wesson in that sense. So that's awesome, all right? That's the first thing I've seen that I really, really like, all right? Let's go. Oh, I need to look at number of shares. Let me get number of shares real fast. Let's see, ordinary shares number. And you'll see, okay, we bought back shares a while back, but then it's kind of, if anything, been diluting slightly. So it's not terrible if the number of shares is not going down because management's not buying it back. But at the same time, I'd rather see it than not see it. The reason I say it's not terrible is that, just because management's not buying back shares doesn't mean that the stock's not undervalued. But I don't know. I prefer buying back shares, right? Okay, so let's see. Yeah, there is some dilution even too, so not really a fan of that. What's this most recent number? I got to get this. 17.7 million. Okay. All right, that is enough of the balance sheet. Let's go to the cash flow statement. So really there's three ways to think about the cash flow statement, right? Not three ways. There's three things you need to look at with the cash flow statement. The operating cash flow, investing cash flow, and financing cash flow. And each one will tell you something different. So the operating cash flow is how much cash is coming in from operations, all right? So how much cash is the business generating every quarter? How much cash is going into the company's checking account from a normal operating businesses, okay? And you want this positive, all right? This being negative is really bad, okay? Even if income's positive, if cash flow is negative consistently, that's not good, okay? Cash flow from operations. So you want to see positive operating cash flow, and that's what we see here, positive and growing. So that's really strong. Okay, so that's the operating cash flow. The next piece is investing cash flow. So investing cash flow is whenever the company spends cash to invest in either capital expenditures or new acquisitions, that sort of thing, all right? So if a company is CapExing, CapEx will go into investing cash flow. If they're buying other companies, if they're buying equity and other things, it'll go into investing cash flow. So in general, this is usually going to be negative. If it's positive, it means that they're selling equity or they're selling assets. That's usually not a good thing to see this positive. But at the same time, you don't want it super negative. Or if it is super negative, you want to investigate and figure out where's the company investing money and are they investing it wisely, right? Because if they're really negative in investing cash flow and investing in a ton of new acquisitions and a lot of new capital expenditures, they could just be pissing your money away, okay? And like I would say companies like AT&T and Verizon do that kind of stuff if you want to see an example of what not to look for or what not to do. All right, now let's go to financing cash flow. All right, financing cash flow is pretty simple, all right? It's broken down into three sections, and I'll pull them up right here, okay? So the big ones are, let's see, well, I zoomed in too much. The payment of debt or going into debt, so net debt. So are you paying off debt or are you going into more debt? Going into more debt would actually be positive financing cash flow, and paying off debt would be a negative because it's cash leaving the account, okay? So it's a little bit backwards, but here financing, if you're paying off debt, it's negative. If you're going into debt, it's positive. All right, common stock issuance. All right, this is kind of works the same way. If they're diluting, if they're issuing new shares, you're going to see this be positive. But if they're buying back shares, if they're spending cash to buy back shares, this will be negative. So we want to see negative here too, same as the debt. Dividends paid, any dividends are going to be negative, all right, because that's cash that's leaving the bank account going to the shareholders, all right? Positive on dividends would be terrible, right? That'd be like they're charging the shareholders a reverse dividend. That'd be a nightmare. All right, then they have some options that's kind of tied to the common stock issuance and other financing, okay? But the big ones are dividends, stock, and debt, okay? So what I'm going to look for here is I'm going to break it down. I'm going to see, are they going into debt? And the answer is no, they're not really paying debt because they don't have any debt. Are they diluting shares or anything? No, nothing's really going on with the stock. And finally, the dividend, and you can see this is where they're spending a lot of their cash in the financing section, which is good. They're paying, let's see, how much is this? The last 4 quarters, they paid almost $60 million in dividends, all right? So to put that in perspective, $60 million divided by the number of shares, which we said was 17.7, they're paying about $3.40 per year to you as a dividend, all right? So you divide that by 58, and that's like, well, shoot, that's more than a 5% return that I thought at the beginning. So really strong, all right? That's awesome. You probably want to check those numbers yourself, all right? That was quick math. And then lastly, what I want to do is go to free cash flow. And this is a yearly number, trailing 12 months. So this is great. This is what I love to see. All right, if you gave me the choice between you can have either growing income and flat cash flow or flat income and growing cash flow, I would much rather see this, right? You'd much rather have more cash coming in, because what's income? Income is how much money you're making that you're paying taxes on, all right? So it's like paper gains almost, right? Cash flow is like real cash coming in. That's cash in your pocket. You want that high and income low, all right? That's how a lot of people who invest in real estate and all that make a lot of money, is they pay very little taxes because they have a low income, but they have a lot of cash flow coming in from the properties and all that. All right, so yeah, this is incredible. Look at this free cash flow, okay? So it's just growing. I mean, I'm going to say they went from 20 to 80 in 13 years. So 80 divided by 20, that's 4, raised to the 1/13th. and that's 11% growth rate. All right, so their free cash flow is growing at about the same rate as their equity. So in my opinion, those two are more important than income. All right, because like I said, income's how much money you're making on paper, how much money you're paying taxes on. Cash flow and equity, that's what really matters to me, and that's awesome. Okay, so I'm gonna put the free cash flow as 80 million, and then I'm gonna say their growth rate is 11%. That's what it's been historically. I'm not going to say that's what it's going to continue to be, but anyway. All right, that's enough of the cash flow statement. Let's go to valuation. Okay, so the valuation screen is a work in progress. I'm trying to figure out how I want to present this because I think, contrary to what a lot of people say, the valuation section is the least important of any investment decision, right? I think that, finding a company that you really like that has great financials, that you think is going to continue to grow and has a solid moat and all that, who cares if your valuation is plus or minus 10% or really even plus or minus 20%, right? Warren Buffett has a quote that's something like, if somebody walks in the room that's 400 pounds, you don't need to know if they're 380 or 420 to say they're fat. And I agree with that. I don't think that you need to get this down to a T. You need to know what is a good stock, what's a good undervalued stock, and just kind of go from there, okay? But that being said, I'm going to show you some examples of what different discount rates and different margins of safety will do to your ideal entry price, okay? So let me just show you with the free cash flow example. So let's say you have $80 million of free cash flow. Perpetual growth rate, they're not growing at 11% a year, okay? That's crazy. I told you the firearm market grew at about 7% a year historically, so I'm going to put 5% for perpetual growth, and then a discount rate. This is where, I think a lot of people differ in opinion. Okay, so let me show you what I do, which is like a 15% discount rate. And you can see that I get a fair value of $52 a share. And then if I apply a margin of safety of about 80%, you can see my entry price would be about $40 a share, okay, $42 a share. Something I've seen other people do, which I think is a perfectly fine method, is to discount at 10% and put a 50% margin of safety, okay? So 10% discount rate, 50% margin of safety, and you can see their entry price would be $49 a share, okay? So still pretty good, all right? And then the last thing I've seen people do is 12.5% with a 67% margin of safety, so 2/3. And you can see there that one kind of matches with what I do. I kind of do either the 12.5 or the 15. I mean, really, look, my valuation section is not an exact science, okay? But you can see you come up with about the same numbers doing it all this way, okay? So we'll keep it here at this Goldilocks 12.5%. You'll see that our price target's $68 a share, margin of safety 67%. That puts the entry point at $45 a share. Real quick, one thing that's just worked well for me is to just take what you think the pre-tax income is going to be, multiply that by 10, and divide by the number of shares, all right? So I said the pre-tax income would be like $20 million a quarter, times 4 is 80, times 10 is 800. Then if I divide that by the number of shares, I'd get like $45 a share. Like I said, that's worked well for me, but really this is the least important section of valuation, okay? What you want to do, and I'm going to repeat myself because I think it's that important, really what you want to do is try to learn what I talk about in the first parts of the video, where you're looking at the financial statements, trying to figure out what company has staying power, what company's got a moat that's going to grow and just continue to prosper, okay? But anyway, that's all I got. I hope you learned something. Let me know if there are any other stocks you want to see. Real quick, both my Smith & Wesson video and my Atcore video, which the Atcore video talks a lot about the magic formula if you're interested in that, or right over there. So watch those. I'll see you next time.